Hello everyone, my name is James Perry and I'm a lecturer for ACCA Belfast. And in this short video lecture, we'll be looking at a technical article regarding Clarity Auditing Standards. Okay, Clarity Auditing Standards were issued in 2009 by the International Auditing and Assurance Standards Board, the purpose of which was to make the standards more understandable for users, i.e. to make them more clear. There was 39 documents that were released. That is, one new standard on communicating deficiencies in internal control, those charged with governance, which is ISA 265. The remaining 35 ISAs were rewritten in a more clear and concise language, and a new standard on quality control, which is ISQC1. Also along with this was a revised glossary of terms and a revised preface to the auditing standards. So in this short video lecture, we'll be looking at two Clarity Auditing Standards. First one being ISA 265, relating to communicating deficiencies and internal controls to those charged with governance and management. So this standard deals with the auditor's responsibility to communicate those charged with governance whenever there are any deficiencies in internal controls that has been identified throughout the audit. This is initially assessed in the planning stage of the audit, where the auditor will consider what type of approach to use in the audit of the financial statements. If the control environment is strong, they may use a controls-based audit approach, or alternatively may use a substantive testing approach. In terms though of internal controls, the auditor has to assess for any deficiencies that may exist. A deficiency exists when a control is designed, implemented or operated in such a way that is unable to prevent, detect and correct misstatements. In terms of both P7 and F8, this is a very common question where the examiner may pose a scenario of an entity's control environment will ask you to assess whether there are any significant deficiencies and what approach that would have on your audit techniques and how you communicate these issues to those charged with governance. Now, if a deficiency is significant, therefore, in the auditor's professional judgment, they must assess whether this will lead to material misstatement or not in the financial statements. And if it does, how is that communicated then to those charged with governance? Points that we should consider include whether the deficiency may lead to a material misstatement in the financial statements, not only in the current year, but perhaps in the future. The susceptibility that the misstatement may lead to loss or fraud within the organisation. Any impact on estimated amounts. Or, for example, the frequency of exceptions detected as a result of the deficiencies in the controls. What that means is how many misstatements actually arise throughout the audit, no matter how small. So, if you've considered these items, in terms of real practice or exam questions, what type of examples may indicate significant deficiencies in internal controls? Okay, well, for example, management fraud, which hasn't been highlighted by internal controls, are mitigated. Perhaps there's not sufficient oversight by management in terms of the financial reporting process, or there's maybe been no implementation of any corrective or remedial actions for any significant deficiencies that have been found in the past. Perhaps there is no risk assessment process within the organisation, or for example, there's been a restatement of previous financial statements, an example being a prior adjustment. That may be an indication of a significant deficiency in the internal control environment. Or there could be an overarching deficiency, which could be management's inability to actually oversee the preparation of financial statements. Therefore, there's an inherent weakness within the entity's financial reporting environment. So therefore, if there are any internal control weaknesses or significant deficiencies, this must be communicated to management. And it's commonly communicated in writing at the audit closeout meeting, which will be between the audit partner and management, and can actually be escalated to the board of directors. So in the communication, there will be a description of the deficiency and the implications of that deficiency. So things to consider in terms of whether it's a public interest entity, therefore you need to disclose more detail to those charged with governance. If the entity is complex and the significant deficiency has a huge or significant impact on the financial statements, again, that must be communicated in sufficient detail. Also, for example, if the board or those charged with governance don't have enough detailed financial expertise, therefore the auditor has got the duty to report enough detail and in enough clarity the impact of the significant deficiency of internal control. So a number of considerations that has to be looked at there. The second clarity ISA that we will look at, which actually feeds off any significant deficiencies in internal controls, is under ISA 450, which is the evaluation of misstatements. If there are any misstatements that actually come through in the audit of a set of accounts, that actually indicates a significant deficiency in internal control. So therefore, both clarity ISAs are very closely linked. So this ISA 450 highlights the importance to focus on deficiencies and misstatements throughout the audit and what impact that may have on the audit process as a whole. So the ISA 450 deals with the auditor's responsibility to evaluate identified misstatements and then to assess the impact of any uncorrected misstatements. A misstatement is defined as a difference between the amount, classification, presentation or disclosure of a financial reporting of a financial statement item and the applicable reporting framework. Misstatements can arise from fraud, but also can arise from human error. And a key consideration is whether the misstatement is material to financial statements, i.e., does it impact the true and fair view of a set of accounts? Remember, that is the key consideration of the issuing of an audit report. Are these financial statements true and fair? So therefore, the auditor has to determine whether the nature or the circumstances for a misstatement could actually materially impact a set of financial statements, both in an individual level or in aggregate, i.e., would the number of smaller material misstatements actually add up or total to a significant material misstatement. This has to be assessed and reported to the appropriate level of management. The auditor also needs to consider whether there is any revision required to the audit plan in respect of identifying significant material misstatements. So does the initial conclusion or the initial recommendation of an audit report need to be revised? Does the audit strategy and the audit plan need to be reassessed and recommunicated? There are aspects that need to be considered. So in a similar manner to internal control deficiencies, any misstatements has to be communicated to those charged with governance. Again, that's normally at an audit closeout meeting between the audit partner, management and board of directors. And in this meeting, it's discussed whether these statements should be adjusted for or not, normally on the grounds of materiality. So misstatements that haven't been adjusted are called uncorrected misstatements. And these again, once agreed with management not to be corrected, should be assessed both individually and in total, again to assess whether this has a material impact on the financial statements. So the auditor will consider the size and nature of the misstatement and the circumstances around those, and the effect of the uncorrected misstatements relating to current periods and prior periods, and the effect on the audit report. So once agreed, the auditor will communicate these uncorrected misstatements with those charged with governance, and in return will expect to get what's called a letter of representation from those charged with governance, which will sign off from the board of directors and management to say that the uncorrected misstatements do not have a material impact on the financial statements, again individually or in aggregate. So again, a number of considerations in terms of that clarity ISA regarding misstatements. So in conclusion to this short video lecture, a number of points have to be considered, not only with those two individual clarity ISAs, but the clarity ISAs as a whole. The key consideration for your exam must be not only to know the detail of clarity ISAs, but to be able to apply the clarity ISAs in a practical scenario which will be posed by the examiner. In the examiner's reports, it is stated that candidates do know the background of the ISAs, but they cannot practically apply these rules in a scenario that's posed in a question. So therefore, it's key to practice a number of exam questions to understand how to apply the clarity ISAs. So hopefully this short video lecture has been of some benefit. Hopefully you do well in your studies, and thanks for listening. Thank you.